Hey guys, I've got a treat for you this week. We're on with Faber, who we try to get on at least once a year. I'd have him on every week if I thought it wouldn't clog his schedule up. Um, he's one of my favorite all-time writers and kind of market thinkers, I guess is the right way to put this. Mev is the co-founder and CEO of Cambria Investment Management. They do a bunch of ETF stuff. I'll let him talk about that as much as he wants to. Host of the Meb Faber Show on mebfaber.com. I don't listen to many podcasts. I try to make it a point to get to that one every week. I don't always make it, but he's always just got great guests and great topics and tons of information. He's written several books. I've lost track of how many, but if I remember the story, you got mad because somebody was reselling your books on Amazon at inflated prices and started giving some of them away for free.
Most of them are for free now. The
Yeah.
ebooks, you can find them. We actually have a new book coming out next year. I'll tell you about later.
Okay. Yeah. So I know that there's four for free on the website right now at medfaber.com, including two that I really want to talk about today, and that's global value and global asset allocation. He's written too many white papers to actually count. I mean, it just, you keep, next of papers studying the market and what works and what doesn't work. And Meb has been, along with me, one of the very lonely voices over the last several years, talking about two of the most unpopular subjects in markets today. That's global markets and value investing. And then if there's anybody left that we haven't really made angry, we go ahead and talk about trend following a little bit, and then that just wipes out the room. But I wanted to have you on specifically because you just sent out a couple weeks ago your quarterly valuation updates for the global markets, and I look forward to these. I'm aware of the information, but having it all there in one place is just kind of cool and a great thing to look at. And it's very controversial because you've got stocks that are the most undervalued that in countries that are hated. Like for instance, this year is Colombia, and we already know that Colombia managed to climb onto the top of our esteemed president's list of countries. Poland is on there, right on the verge of the war zone. Turkey, um, and those countries have been on there for a while. And all the countries that are unpopular and nobody wants to go are the best stocks on that list, countries on that list. You threw out some performance numbers in a tweet not long ago. Can you share those with us?
Yeah, lost in everyone. You turn on CNBC, read Bloomberg. Everyone all day long is talking about U.S. stock market being an all-time high. And that's well justified. It's been an amazing run for the past 15 years. It's been a 10 bagger. You've been in the Qs. It's been a 20 bagger. People have made a lot of money. It's been one of the most exceptional times ever to be invested in U.S. stocks. My favorite chart of the last few years was a rolling 10-year returns of the U.S. stock market. And there's only been 4 times in history it's done 15% a year for 10 years or an extended period. And it was the roaring 20s, nifty 50s, internet bubble, and today. So there's a good reason everybody talks about U.S. stocks, but it's constant. It's NVIDIA. Starting to talk about gold a little bit now that it's over 4,000, but that's kind of
Right.
the main topic. And we're having another good year in U.S. stocks. But underneath the surface, the turbulence of the white water and the waves is the foreign markets, which have underperformed for forever, really, have started to turn. And you have foreign developed, foreign emerging, outperforming U.S. stocks, but in particular, global deep value. It's actually the hat I'm wearing currently. If
Okay.
you're not watching this online, this is our GVAL ETF. But the global deep value of the cheapest countries in the world is putting up almost 50% up year performance. And, like you mentioned, these are countries that often people shy away from. But there's a lot of countries in that basket that historically you wouldn't associate with necessarily being geopolitical risks. UK has been in there, China has been in there, on and on. And so it's a lot of Eastern Europe. I think Poland is one of the best performing countries this year. So I think a lot of people are very underallocated to foreign, of a percentage of the global market cap, US investors, it's a third ex-US. And US GDP is only a quarter of the world, but the vast majority of everyone I talk to puts everything in US stocks, which is cool. If that's your thing, good, go for it. But historically, that's been a suboptimal way to invest, putting all your money into one country.
Okay. So that brings me to the next question when it comes to US stocks. 15% decades are really unusual, as you just pointed out. All the periods that you just named ended badly. The roaring 20s, the 50s, the internet decade. How's this one going to end?
We don't know. This book I'm writing is called Time Billionaires, and it looks at a history of the stock markets back to 1600. And what you find is a long history of booms and busts and periods where, other stock market countries held the crown as biggest in the world. For a couple hundred years, the US wasn't the largest stock market. There was no US, right? It was the Dutch and then the British and US. And even as recent as 50 years ago, Japan was the biggest stock market in the world. And so, these names change places over time. And it's not just the countries, but also sectors. 100 years ago, we'd only be talking about railroads or utilities as opposed to, tech and financials and everything else today. And so these stocks tend to have cycles. And sometimes these cycles last what's essentially a lifetime. 15 years for many people is an entire career. I was joking with someone this week. The NBA season just started, and they were
Mhm.
asking a bunch of the younger players. They said, "Hey, what do you remember about the 90s NBA?" And to a T, all of them were like, blank stare. They're like, "What are you talking about? I wasn't even alive."
Right.
I was born in the 2000s. And so the reason I bring that up is that all of us extrapolate our own lived existence, not just in our own lives, but also in investing. And so if you've only been investing in the last 15 years, you've learned over and over and over again that you should put all your money in the S&P and nothing anywhere else, and it doesn't go down. Now, we wrote a paper on this a couple of years ago called The Bear Market and Diversification, where a diversified portfolio, it doesn't matter if you do 60-40, risk parity, endowment, on and on. This would have been the worst period in history in the past 100 years for a diversified portfolio relative to the S&P in terms of magnitude of drawdown in years in a row. The only thing comparable is post-World War II. Now, I think that's changed. In the last year or two, you've seen a lot of assets gain momentum, most notably being foreign stocks and gold. Bitcoin is kind of always doing its own thing, but those two in particular have really started to outperform to the point where it's making it's starting to make a little noise.
Okay. Brings me to a question that US market, everybody favors it. Money's still flowing into it on a regular basis. Nobody I talk to on a regular basis has much money allocated to global markets. A few years ago, I told my wife she was making some changes in her 401k, and I put it into the global markets. And your HR was like, "Really?" And of course, it's worked out pretty well. But are we in a bubble? Has the U.S. gotten to the point where we need to throw the caution flag on the field because valuations are just too high?
Yeah, my son's entire 529 is in ex-US stocks, but he's only 8, so he has a lot of time to catch up.
Right.
And who knows? He may not even be going to college in 10 years. It might be all AI education. We'll see. And just football games and beers at that point. Who knows? But let me dovetail on kind of the question you asked on the last question, which I didn't answer. I'm sorry, but
That's okay.
when looking at the US, what is most likely to happen? We're at a 10-year PE ratio of around 40, which has only been exceeded once in history, which was the late 90s. Usually it's about half of that, somewhere around 20, low 20s, where the rest of the world is. Most of the rest of the world is bouncing around 20, though there's some countries in the teens, low teens, even single digits. So the US is expensive. Now,
Mhm.
on average, when a country closes the year above 40, and this has happened a bunch in the past, so think India and China back in 2007, the US, a lot of things in the late 90s, Japan in the 80s, future 10-year returns on average are after inflation are about zero.
Right.
So not great, but probably low single digits on a nominal basis. But never once have they been above average in the future 10 years. So meaning your batting average, your hit rate is pretty low. So expecting 10, or God forbid, like the youngins these days, 15% returns on your US stocks in the next 10 years is probably unlikely. That doesn't mean it can't happen. And so
Right.
for a lot of these markets to go from a PE of 40, it could go to 60, it could go to 80, it could go to 90. Now, the whole idea about capital markets is that you're paying for the future stream of cash flows. And so the more it goes up in the short term, you're sort of mortgaging your future returns and vice versa. So we think the US market cap weighted, low expected returns, but within the US, a lot of opportunity for small and mid cap, for other sectors, for value, for foreign, for emerging, for value outside the US. Basically, anything other than US market cap weight is sort of what we tell people. Even fixed income, bonds yield 4% plus, T-bills for the first time in a long time. People got accustomed to 0%, and all of a sudden you got a competing asset now at
Right.
4%. So I think there's a lot of choices outside the US, as long as you have a long enough time horizon.
Okay. Now, the cheapest markets in the world, and I've got the list in front of me. So I'm just going to bounce these out here so folks kind of know what we're talking about. And where did it go? There it is. All right. No, I don't. I know Colombia is number one, the absolute bottom. I believe Poland is still on the, hang on a sec, because I did absolutely lose my page here. So I apologize for that.
No problem.
Ah, there it is. Okay, here we go. So Colombia's bottom, Brazil bottom. Also, and remember, Brazil is massively out of favor with the United States right now. Thailand, a country that people talk about a lot, but I don't think most folks can find it on a map. Turkey, always controversial. Poland and Chile are the bottom countries. Now, I know how you keep score of this, and I know how you're measuring value, but can you kind of detail that for folks exactly how you're determining the overall valuation level of
Sure.
a country?
We say it's important. We think valuation is a blunt tool. So we actually track. So we write the Idea Farm, which is a website, shares research. It's free. Once a quarter, we'll put out this ranking of about 45 countries, and we rank them across, I think, 4 different 10-year valuation metrics. So we use earnings, we use dividends. By the way, the S&P's dividend is 1.17,
Right.
also knocking on the all-time low of about 1.1, super low. We do price to book, we do cash flow, and we average them, because these countries, any one metric may be slightly biased, but in general, if you're someone like the US who's trading at a 40 PE, the other ones should agree or at least rhyme. And ditto, if
Mhm.
something's trading at an 8 PE, they should rhyme. And so we take an average of all these countries, and the names switch over time. And the US on the PE ratio has been as low as 5 before. So it's not like it's always at 40. It goes up and down over time. And so on average, the ranking, the US is actually, we've been doing this for over a decade. I don't think we've ever seen it as the most expensive country. And it entered this year as the most expensive. For a while, Denmark and India were up there. But the U.S. is sort of bubbled up to be the winner, and not in a good way. So I think the key thing, though, on this idea is that you got to remember some of these countries are smaller. So if you're investing in Czech Republic or something, you're not going to have thousands of securities like you do in the U.S. You may have
Right.
10, 20, 30. And also, you want to buy a basket of these. You don't want to come off this podcast and said, I heard Tim and Meb, and they said, I got to put all my money in Colombia. No, that's not what we said. You want
Right.
to buy a basket of these countries because, usually the way they get into the low PE is the P, right? The P goes down 50,
Right.
80% or something. And that gets you to cheap. And often it's justified, but it usually goes too far. People extrapolate just like they do on the right side of the chart, and on the left side is becomes career risk. If you buy something that is done very poorly, people look at you like you're crazy. But on average, value has been a great strategy.
Let's touch on that for a second, because career risk is something that I've heard you talk about. I've heard Wes Gray talk about, and I haven't heard anybody else talk about it. But it's, having been a broker, I can tell you it is one of the biggest risks on Wall Street. So let's talk about career risk and what it is and how it affects the individual investor.
Well, Wes and I are both a little crazy, so I'm not sure that's the best sample size for your listeners. We both got a screw loose. But yeah, I mean, look, so much of our world and industry, you got to trace it back to incentives. Why are people saying or selling what they're doing? Are they investing in their own funds? Are they putting their money where their mouth is? And kind of where these incentives lie. I think also, it becomes problematic with um, career horizons, on and on, all these shifting forces on kind of how people are willing to go about what they do. And are they willing to shift? Are they willing to say I was wrong and shift to something else? On and on and on. And I think career risk is something that a lot of people, if you look at this entire industry of active mutual funds being essentially closet index funds. And what do I mean by that is like, hey, it's the best time ever to be an investor. You can buy a portfolio from Vanguard of ETFs for about 3 basis points,
Right.
0.03%. So if you're going to pay 1.5% for some mutual fund or something, you better be getting something super weird, concentrated, different in this search for alpha exposure. But the problem is, so many of these over the years, they may have started out like that when they were
Right.
young and enterprising and youthful and motivated. But then as the assets bubbled up to 50 billion, 100 billion, 500 billion, they just become toll collectors, the fee
Mhm.
collectors. And so you end up with something that looks like the S&P, but you're now charging 1 or 1.5%. And so I don't think, in 2025, you need that, right? I think it's much more thoughtful to get cheap beta where you can, and then if you want something to look a little different, go for it. But so much of the industry is legacy sort of
Mhm.
conflicts like that are best avoided.
Right, and that's I'm glad you brought up the fund and the size thing because I'm very fond of saying that um, true deep value works. It's always worked. It's never really stopped working. It just doesn't scale really well, and we've seen it in countless of the better known value investors who I'm not going to name, but they came up through the 80s and 90s shooting the lights out. But as they crossed that billion and 5 billion mark, performance came right back to the index.
The thing with value, and you can really say kind of what you were talking about for any strategy, you got to be really careful on flows and size. If you're a manager that's investing in Brazilian small cap tech stocks, chances are you can't deploy $50 billion. And so,
Right.
we wrote a recent piece called When to Sell, helping investors walk through. A lot of people put a ton of just uh, effort and blood and sweat into buying an asset or a strategy or a fund. And then you ask them, well, what's your plan for selling it? And they give you a blank look. And,
Right.
often it's like, I'm just see how it goes. I'm going to wing it. They don't establish the criteria ahead of time. And that becomes problematic because we all love to chase returns on both the good and the bad. And so some things, like a good reason to sell, is what you just mentioned, is like asset class or strategy bloat. If you started out, like Buffett talks about this all the time, where he's like,
Yes.
look, if I was managing 100 million, I could do a lot more stuff than managing a zillion. And so the opportunity set just shrinks. And what you can do now, there are funds out there, and we've called out a few over the past couple years, and this is somewhat of an Achilles heel of index funds that have been managed without regard to implementation and size. And we've seen some out there that will just quote follow their index, and then they'll buy 10 or 20% of the float of a small cap stock. And if you've ever invested in stocks and you know that buying 20% of the company, it's going to move the price of the stock. And
Sure.
the question is just how much. And so that becomes a big drain on returns too. So being mindful of the art of actual implementation is hugely important. It's kind of the boring blocking and tackling of our world. It's much more sexy to talk about the investing side and what's gold going to do and the Fed and stocks, but really the basics of implementation on fees and taxes can
Right.
often be equally, if not more important.
Yeah, I think people miss that, particularly on the fees, the taxes side of this, that, when you're trying to be really exciting and trading in and out of a whole bunch of stuff all the time, the winner is the tax man most of the time, the broker and the tax man. The broker's bite has gotten a little smaller. The tax guys really has not. So
Yeah. Yeah.
now, your other book is Global Asset Allocation. And I can tell you I've been doing this a long time, which basically means two things. I'm old and I've learned a lot because you don't get to be old in this business unless you've learned a lot. And one of the things that I've noticed is most people pay almost zero attention to asset allocation. They don't think about it at all. And most brokerages and investment advisors might pay lip service to it, but nobody's really doing what they should be doing with this. You do a lot with this. So can you kind of address the idea of asset allocation and the best way to go about it?
The concept of asset allocation is really survival. We often tell people we're about to hit a 20-year track record at Cambria next year, which is kind of crazy to look back upon. And we say
Right.
the best compliment you can give someone in the investing world is you survived. It's not that you
Right.
generated alpha; it's just you're still here. Because as we all know, investing graveyard is a big one, but also just in life in general. This applies to relationships, jobs, everything else. And so diversification is the same concept. Like you can't find an asset out there that's safe. We wrote an old paper called "What's the Safest Asset?"
Mhm.
And I think a lot of people would assume that that would be T-bills, and that would be right on a nominal basis, but on an after inflation basis, many people would be surprised to learn that if you put all your money in T-bills, you lost half your money at some point on an after inflation basis. And
Right.
so actually the safest portfolio, and this is counterintuitive to many, is a diversified global portfolio. And there's kind of three main buckets in my mind. And the first is stocks, and I mean this globally. The
Mhm.
second is bonds or fixed income. And the third is real assets. And so things like precious metals, mine, commodity equities, tips, REITs. And all of those play somewhat different roles. Sometimes they zig and zag together, and sometimes they don't. But over time, the benefits of diversification are very real. And so the biggest challenge for most US investors, A, they put all their assets in US investments. So everything is US stocks and bonds. And because of the volatility of US stocks, that means basically they're all US stocks. But they very often have very little ex US equities and also very little real assets.
Yes.
Now, there's certain groups and pockets, if you're Australian or Canadian or Chinese or Indian or certain bugs in the US, you'll have maybe some exposure to those real assets, but often people are very underallocated until after the fact. And diversification gives you a smoother ride, and it's the volatility and drawdowns, particularly with US equities, that take so many people out of the game. I mean, how many times and how many people do you know? I know a lot that
Mhm.
got hammered in the GFC, sold everything, said I can't take it anymore. And then they 2010, 2012, 14, 16, 18 still talk to people, said I never got back in. I couldn't
Right.
take it. And that's tough to hear because like I said, the market's been a 10 bagger in the last
Yes.
15 years.
Yeah.
So I think a lot of people, if you tell them at the end of their life, said, hey, uh, are you bummed out you got 8% instead of 9? They'd be like, no, like, what are you even talking about? But if you said, hey, how do you feel that you got 0 instead of 9 because you weren't able to complete the race? I think
Right.
that's a much, much bigger risk.
Now, and you use the numbers there of 8 and 9%, and I want to touch on that because when so many people in financial media today, they don't talk about realistic rates of return. We've got people walking around out there that with the market at this level and the PE, okay, PE over 40, walking around talking about, I think I'm going to make 15, 20% a year for the next decade. How realistic is that?
Well, apparently you're not hanging out on Instagram enough because over there they say not just, 10, 15, you're going to make 30, 40, 50% a year. And, we've
Wow, that's
identified
that
a
even
lot.
beats Twitter. I mean, wow, that's
Yeah.
big. That's big.
We've identified a lot of frauds over the years, and we try to call out particularly bad behavior. And I made the mistake of bookmarking a particularly offensive handful set of marketing. It's usually like private real estate, private credit, some sort of,
Options.
here, come invest in my trailer park, come invest in my movie, come invest in my just,
Yeah.
but they seduce people with the prospect of high returns. And investors, if they just sat back and compounded over time and focused on the things that are important, saving and investing in the first place, starting early, not mucking it up, paying low fees and taxes, it's magical, right? In 50
Right.
years, you 100x your money, but they get seduced by the prospect of getting rich quick, in which case they usually lose all their money. So now all my Instagram ads are these shady deals. And I have a Twitter thread that has about 50 of them, and I gave up because there's so many. But usually a nice bear market will clean these people out, or the regulators, or both.
Okay. Yeah, that's one of the things that I saw, and I saw this as a broker. I've seen because I work in obviously in financial media, and you're competing against people that will say anything, and they're promising these just magnificent returns and how you're going to get rich by next Tuesday. And frankly, it drives me insane. All right, now you use the CAPE ratio a lot. This is controversial. I know because I use the CAPE ratio. It might have been you that said it one time, and if it wasn't, take credit for it because it's a great statement. Where the CAPE ratio is not a precise timing mechanism by any stretch. Basically, it doesn't tell you when you're going to get thrown out of a window by the market. It tells you what floor you're on.
Hmm.
So the CAPE
That is
ratio,
great. I hope I said that. That's
yeah,
wonderful.
yeah, whoever said it, that's a fantastic line. I use it all the
I'll
time.
take it.
Okay. But you do use it, as do I, to kind of measure valuations and spot under and over identified pockets of the market. What is it and why does it work and why should people pay attention to it?
Yeah, I mean, and we'll get to it. I'll back up real quick. I mean, valuation in general, if you think about it, it's everything when it comes to markets. And if you say, "Oh, I'm not going to use value," you say, "What's the alternative?" Right? Like that
Right.
you're just going to buy investments with your hard-earned money with no regard to fundamentals is crazy because people end up, buying on average. One of the worst strategies in history is buying really expensive stocks. If you consistently buy stocks at 10, 20, 50, 100 times revenue,
Right.
you're going to lose all your money eventually. The thing is, every once in a while, they'll rip up, this little face ripper. Everyone gets hot and bothered, and then they just go back down. And so thinking about valuation, particularly on the aggregate, like the entire market, I mean, most people, when they invest in something like the S&P 500, assume that valuation is already considered. If you talk to the average individual and
Mhm.
say, hey, you're indexing, great. How does that do it? It buys the biggest companies, biggest by what? And they're usually like, well, I don't know, like earnings, revenue, sales, profits, people. And you're like, no, no, no. It's just price of the stock times shares outstanding. And so I think that surprised
Mhm.
people because the big Achilles heel of index investing is when things go nutty to the upside, you're putting most of your money in the things that went up the most, which usually are also the most expensive. And you're seeing all
Right.
the ink being spilled right now about the Mag 7, their valuations, on and on. And so other methodologies, I think CAPE ratio is very useful to at least give you some perspective. And Bogle, Vanguard used to talk about this on how to come up with expected stock returns. They
Mhm.
still publish, Vanguard still publishes their capital market
Yes.
expectations. They also think US stocks particularly on the growth side are gonna disappoint. But I think the CAPE ratio in general, we have two parts to my brain. Well, on one half at Cambria is the value side,
Mhm.
and the other half is trend. And if you go back in history, the best quadrant to be in is in a cheap uptrend, but the
Mhm.
second best is an expensive uptrend. And that's right now. So stocks are
Yes.
expensive on average and they're going up. The worst quadrant is an expensive downtrend. But so right now we're kind of like yellow flashing light. And really until this rolls over, is kind of a like you're okay
Right.
situation. Um, and that's when things get a little dark and scarier. But it just goes to show like there's nothing inherently about a certain valuation level that means stocks have to crash or even go down. It just means that on average, I think they're more fragile. I think
Right.
your description is great. You're on a higher floor. Everything we know about markets, future 5-year drawdown possibility is much higher from a much higher level.
Yeah.
But things can always get crazier. Elon Musk
Yes.
finds free energy on the moon. I don't know. We get all hot and bothered about some new uh, quantum computing or AI development. Like I'm here for it. But on average, that gets incorporated in the price. It gets incorporated in the expectations, and it gets discounted.
Yeah, it's the other thing that when I talked about valuation of the overall market, I refer to it. It doesn't tell you much about tomorrow. Doesn't tell me at all what the market's going to do. It says nothing about tomorrow. It says a lot about 10 years from now. Now, you did reference suggesting forward returns, so I'll bring this up. I track a lot of forward return barometers. There's the aggregate allocation to equities. There's the value line index projected return. There's the excess CAPE yield. There's market cap to GDP. They're all of them right now are saying the same thing, which is kind of unusual.
Yeah.
They're all saying, and even Vanguard's like, yeah, maybe you get 4%, maybe, and that's nominal, not adjusted for inflation. So you're talking some very low forward-looking numbers from here in U.S. stocks. Now, it is telling, at least from the way I look at things, and I'm an old Ben Graham guy, so I look at book value, it's screaming something entirely different about Japan, about pockets of Asia, and about Europe.
And if
Is
and if you look at a lot of these forgotten places, and I even include small mid cap value in the U.S. here.
Yes.
Some of these are at some of the widest valuation spreads, certainly over the last handful of decades. So the opportunity set looks particularly rich in foreign, developed, and emerging. All these really in our shareholder yield funds, you can find single digit PE companies that have great valuations that are paying out, excuse me, 10% shareholder yield through dividends and buybacks. Now, foreign, it tends to be more dividends than in
Mhm.
the US because the US is a bigger culture of buybacks than outside, but that's changing. And if you look at the last few years, you've seen a number of countries start to lean heavily into starting to buy back more shares. Japan, China, UK. On top of that, it's not just that they're buying back shares, it's also that you're avoiding the share issuers. There's serial companies, particularly in my home state here, California. There's companies that love to give the C-suite a bunch of stock-based compensation, reloaded every year, and they get as this constant dilution to shareholders. And sometimes it can be material. In some cases, it's like 5% a year. And so a lot of people out there don't see that, don't know that they're getting diluted, and ending up over time, you own less and less of the company. And historically, it's been a very bad factor for future returns, is stock issuance.
Now, let's talk, since we opened up the door, let's talk about small cap deep value in the United States for a minute, because this is an area where, I mean, the common perception is that value is dead, right? And if it's hanging on, it's only hanging on till Warren dies, and then it's really dead, even though Warren hasn't actually done deep value in a long time now. So deep value is dead, and there's no small cap anomaly. It doesn't really exist. And I hear this all the time now, these two arguments. And you referred to the valuation gap. So how are you looking at that from a valuation perspective and from a historical perspective, more importantly?
Yeah. It's interesting. If you look at, there's often in markets, sort of on a Venn diagram, there's overlapping circles. And so sometimes things that have done very poorly are somewhat co-inherited or related. So if you look at things like small and mid cap, they've done very poorly for so long, and on the similar register is value. And so there's some correlation there and the opportunity set. There's a lot of companies out there that are trading at totally reasonable. It reminds me, I try to shy away from analogs in general, but there's definitely some late 90s
Yes.
vibe to this, where it's a lot of the indicators and comparisons, I think, are pretty reasonable. And that's true elsewhere. And the funny thing about value, is that it's like a swarm of bees or starlings that kind of morphs over time, and it's not always the same. So to give you a good example, for our shareholder yield strategy in the US, tech is a very low allocation. And that won't surprise people if you say value investing. Well, you don't invest a whole lot in tech right now. And that's because, in general, tech stocks are expensive and they're traditionally share issuers. In our emerging market fund, tech has consistently been the number one or number two biggest sector. So it's not just that value avoids tech, it's just value avoids tech currently in the United States,
Right.
but loves it elsewhere. And so these things have a way of kind of bouncing around. And the opportunity in one place can be much better than the other. And so something as simple as value this year, there's a 50 percentage point spread between one of our funds that does value and another one that does value this year. And that's a, Grand Canyon wide difference.
Yes.
So trying to make generalizations of value, investors always, when they love to say it's broken or it's dead, I'll have to follow up and ask them and say, well, where? What time frame are you talking about?
Right.
Because in certain areas, it's doing amazing. But on average, we certainly love value anywhere around the globe.
Right. And I'll just toss out a figure that it shocks a lot of people. When you look at the last 3 years, and you pointed out that deep value foreign markets have outperformed, the cheapest markets have outperformed the Mag 7. You know what else has outperformed the Mag 7 and not by a little bit? Foreign banks below book value. Now, you tell the average American that you want them to buy a French, German, or Austrian bank below book value. I mean, they're going to think that you're just the worst human being on the planet and terrible investment advisor. But they've minted money over the last several years. So,
Well, this is the spookiest Halloween stat, is if you tell someone, say, you're not going to believe this because the US stock market is ascendant, it's all anyone talks about on TV. But if you say, hey, this global value bucket has outperformed the S&P over the last 1, 3, and 5 years, they'll say, no way, and say it's true. And so it's sometimes these shifts kind of happen quietly, and then everyone starts to notice. I was talking about this on gold on Twitter when we crossed 3,000. I said, hey, gold's making some moves, but no
mhm.
one's talking about it really in my world. And then we passed 4,000. I was like, well, people are talking about it now. Like
Everybody's
it's
talking about it.
everyone's talking about it. So I feel like that's the same as with any investments. And as long as the S&P is doing 15% a year, everyone's fat and happy. Money doesn't feel like it needs to move. Money is pretty sticky as long as things are going up and things are all roses.
Mhm.
But at some point, people start to notice. I joke with my financial advisor friends. I say, for many years, people open up their client statements every quarter and they're like, what are you doing? We own emerging markets. Why? We should put all of our money into the S&P.
Right.
And then I joke, at the end of this year, they're going to sit down. They're going to like, what are you doing? We don't own any emerging markets. I told you we should have owned emerging markets. What are you doing? And so
Right.
clients tend to have a short-term memory. And I think once people start to see an extended period of ex-US outperformance, it'll start to see some flows and behavioral changes.
Right. Now, speaking of emerging markets, can you use the same valuation and metrics to invest in emerging markets that we do for more developed markets, or is there some extreme measure that we need to bring into play?
I think in general they're good. If you, I have a whole series on my blog called like 20 things that you may not know about markets, and one of them is, if you look at global GDP, US is only a quarter. Emerging markets are actually a majority of world GDP, which always surprises
Right.
people. And it turns out there's a lot of people in China and India and Indonesia and elsewhere. But I think it works even better. So our shareholder yield book, which we just did a second edition of, again, it's free online. When after we published that, I don't know, 12, 15 years ago, a lot of academic research came out, and a lot of it found that strategy worked even better in emerging markets. And the argument would be that they're less efficient than all the money that's focused on the US. And this is also true, I think, between large cap and smaller micro caps, where there's 50 people analyzing one stock, or analysts covering it, and some small cap is zero.
Right.
But also with emerging markets, what's interesting about value, and particularly shareholder yield, which is dividends and buybacks, is the biggest nervousness people have about emerging markets is say, I don't trust the numbers, I don't trust the management.
Yes.
And a shareholder yield approach, to me, the best takeaway is that if you're paying out 5 or 10% of your cash flow per year through dividends or net stock buybacks, that screens out a lot of frauds, because the
Yeah.
frauds or people who have crappy businesses are buying jets, they're paying bribes, they're naming stadiums, they're spending the money. What they're not doing is returning it to shareholders, because the return it to shareholders means you either have to have a ton of cash or you have to be generating a ton of cash. And so, on average, in emerging markets, I think it does a great job of finding high quality companies that are run with regards to shareholders in mind. Now, it won't be always, of course,
Right.
but in particular, we now have 5 shareholder yield ETFs. I think the one in the emerging markets is going to be the one that ends up with the most outperformance over time because of that reason. And the index tends to be fairly inefficient too,
Right.
uh, uh, as well.
Okay, now before we get to the easy ones of new stuff that you've got going on, let's tackle a couple more fun ones that are a little more controversial. Back in 2023, you wrote an article, 19 things that you disagreed with everybody. You were out on an island. I was there with you on the island for most of them, but one where we both got blistered. You more than me because you said it first. You said you think the Fed is doing a good job. Still true or not true?
You know, I joke that there shouldn't even be a Fed, because you can
Right.
just tie the Fed funds rate to the 2 year and be done with it. Just call it a
Sure.
day. Say here, because if you look at if you pull up a chart of the 2 year versus the Fed over time, and our buddy Tom McClellan does a great job of this. Eventually they sync up. There's periods
Yes.
where one is way higher than the other, and usually that's periods of dislocations where they're way too high for too long or way too low for too long. But on average, they catch up. So I always joke. I say I could run the Fed just once a quarter. We'll get together, have some beers, and then just peg it to the 2 year. We can't tell anyone we're pegging it to the two
It's a
year, because then the market will expect it. But on average, I think to me that's a thoughtful way to go about it.
Okay. And then the other one is trend following. Trend following is right there with value investing. We all know it works. It's been proven. We don't have a little bit of data. We have hundreds of years worth of data that deep value and trend following work. Everybody will try everything else but those two. Does trend following still work?
Absolutely. Well, you now you get into the philosophy part of the
Right.
discussion.
Right.
I think market cap investing is trend following investing. Like, no question in my mind. Like, if you're Bogle Index, your algorithm is price of stock, shares outstanding. That's it. Price goes up, you own more. Price goes down, you own less. That's literally the world's simplest trend following algorithm, and it eventually gets kicked out when it goes down too much or goes to zero. So historically, market cap indexing is trend at its most basic. But I think when most people think of it, they think of it in terms of a macro approach. They think of it, we implement it long short. We implement it long flat on our GMOM Global Momentum Fund, but we also do managed futures, which is long short. And just like value, when I said there's a 50 percentage point spread this year, in trend, there's also a 20 plus 5 percentage point spread based on what markets you trade and your approach.
Mhm.
And so the managed futures world is having one of its worst years ever in terms of 12-month performance. Now, it's not bad. It's like flat or down 5% or something. It's not like it's down 30 or 50. It
Right.
just is not doing great. But over time, to me, they're the two most sensible investing approaches in the world, and they've both been around for 100 years, and they complement each other, which is one of my favorite parts. Right? Is that value? The struggle with value, in my mind, a lot of the time is A, you can be wrong, and B, it just can go a long period where some like the animal spirits of today are just going crazy for just about anything that is a narrative or a story. And trend, like, the cool part about trend is it's hard sometimes to
Mhm.
buy or sell an investment. I think back in 2007, trend signals, hey, you got to sell your REITs, and I was like, I don't want the party to be over. It's not time yet. And the same thing in COVID. I remember, everything was crashing, and at one point, trend signals to get back in. I was like, oh man, this feels like this has way more to go. This feels
Mhm.
like the zombie apocalypse. I don't want to get back in now. So I think for trend, a lot of times, the good news is for most US based investors, often trend style funds that are global not just have the exit, the parachute, the sitting out, the risk management, but it often gives you exposure to assets you probably don't have. So if you
Right.
think about our global momentum fund, I said it's mostly foreign stocks and gold and miners. Most investors don't have that in their
Right.
portfolios, and Bitcoin. So it's sort of a. I often say that trend is the premier complement to a traditional buy and hold portfolio. And we're probably the
Okay.
biggest outlier in the whole world on that idea. I say the default is about half is what
Okay.
people should put in trend relevant to a traditional portfolio, but it's not for everybody.
Right. Now, just a quick answer before we get into what you're going on is 200-day moving average still a pretty good trend tool or no?
Yeah,
Yeah, I thought so too. Okay.
great.
There we go.
Not just
One
pretty
more.
good, great.
Okay. All right. New stuff going on. You're up there some pretty cool stuff in the ETF world. I'm not even going to try to explain this, but you're doing something called 351 exchanges for your clients now. Can you explain what that is and why you might want to consider it?
There's probably people listening to this that say, "Ooh, Tim, Meb, I love what you said. This is really thoughtful. You guys are handsome, intelligent. However, all my investments are in taxable accounts. So I can't sell my Microsoft I bought in the 80s. I can't sell my Qs that have been a 20 bagger. The tax man's going to kill me." And historically, there's been very few choices. You can die, you can donate them, or you can not sell them and just hope things work out. If we know anything about concentrated positions, it usually doesn't. And lastly, you can just sell it, pay the tax man, and move on. Well, in real estate, there's been a solution for this forever called the 1031 exchange. You buy a building, 20 years later, you want to sell it. You're allowed to sell it, buy a different building, and it's a tax deferred transaction. Generational wealth has been built this way for a very long time in real estate. Well, there's been something in the tax code equally for, I don't know, 80 plus years called 351 exchange, and it's about contributing assets to a corporation. So if Tim and I were starting a farm with a third friend, Tim brings the seed, I bring the barn, they bring the tractor, you put it all in a corporation, that's not taxable. Well, it's found the 351 has found its perfect spouse with the ETF structure because ETFs can trade tax efficiently. The SPY launched in the 90s, rebalances all the time, has never paid a capital gain distribution, 30 plus years, right? So that's a massive, massive benefit for investors. So what happens is investors can contribute a portfolio of stocks or ETFs. So it's got to be publicly listed. It's got to be tradable. So no futures, no options, no Dogecoin, and they can seed an ETF getting launched and get an ETF back in return. Now, there's two main requirements. The biggest position can't be above 25%. So IRS doesn't want you doing this for tax reasons alone. So you can't just give me 10 million NVIDIA. It could be 2.5 million NVIDIA and 7.5 million something else. And then the top 5 positions can't be above 50%. So what does all that blah, blah, blah mean? That means you need at least 12 stocks or, and this is a giant, or ETFs are pass through. So you could actually contribute 100% SPY because it looks through to the underlying holdings. So who is this for? This is for someone who has concentrated taxable positions. It's for someone who does direct indexing. It's someone who wants to rebalance your portfolio away from maybe something that's done really well into something else. So we've done 3 of these and they're getting bigger and bigger. The last one we did in October, and 2 months ago was 150 million. We have another one coming up in December. If you're watching this online, USEW, see that nice flag.
Yeah.
And the way that it works is, you about a month before, so coming up now, it's launching mid-December. You reach out to us, we work with you, you say, here's my portfolio, make sure that it fills the diversification requirements, blah, blah, blah. The portfolio transfers to US Bank, comes back, you get an ETF. And here's the great part. So first of all, reminder listeners, it's not a tax wash. you still owe, you still keep the same cost basis. It's just a great tax deferral to a more diversified portfolio. Um, and the cool part is, let's say you submit 20 positions, you now have 20 separate tax lots that you can manage going forward as you see fit. So it's a pretty interesting concept for a lot of use cases for a lot of people. We got a lot of stuff on the Cambria Funds website: PDFs, white papers, videos, podcasts with our buddy Wes, etc. So a whole bunch of material if you want to get into it. It's a little, 99% of people have never heard of it. So there's been over 100 of them that have been done. Traditionally, it's been like one fund converting to another. We're, along with Wes, kind of the first to do it open enrollment, which is, I think, a pretty cool idea.
Okay. All right. Secondly, we can't let you go. If you got a new book coming out, you got to tell us about it. What's going on?
So, Time Billionaires, which is going into sort of production at this point, as far as all the charts and graphs. I got really frustrated during kind of the COVID period, where there's a lot of young investors that became interested in markets. But the problem is they got led through the casino door, through Robinhood and confetti. Hey, buy some options, trade these stocks. Hey, trade them some more. Here's some more confetti, on and on. And now you have all these products that are, I think, pretty predatory. And so it's frustrating, because I want as many people to be, I want every American to be invested in the equity market. I think it's awesome, participant in this amazing thing we call capitalism. At the same time, I want people to understand and learn, how this works. And so, you've all seen this chart of the U.S. stock market last 100 years and all the crisis events over the past 100 years. We're essentially doing that, but back to 1600. So we're doing a global markets, history of stock markets, a lot of fun ideas along the way, but to take this long-term perspective, meaning, hey, start to save, start to invest, put it away in these global stock markets, and pretty soon, blink, you're rich. You've made a lot of money. You don't need to go YOLO into all these meme stocks on a daily basis to try to get those 50% returns. So Time Billionaires, hopefully out in early 26.
All right. Well, thank you very much, Meb. First off, thanks for spending an hour. I told you I wouldn't keep you an hour. I did. Sorry about that. MebFaber.com.
Let's do it again sometime. And
Yes.
for the listeners out there, go Dodgers.
Oh, okay. There we go. MebFaber.com is the website, and there are links through there to all of the ETFs, to all of the white papers. Also, look, Meb is one of the few guys besides myself that puts transcripts on his podcasts. So if you're like me and you'd rather read it than listen to it, it's there. And he's got some of the best guests in all of finance on a regular basis. So check out the podcast. And then Meb used to charge $500 a year for the idea farm, and he got it on a regular basis. He decided to open that up, make it more public. It's the best research that you're going to see as an individual, bar none, and he's not charging for it anymore. It comes in every week, I believe, on Sundays, and there's usually 7 or 8 just fascinating research papers there that are institutional quality that you're not going to see anywhere else.
By the way, we just redesigned the Idea Farm. So if you haven't been back recently, check it out. This goes out to 100,000 people plus. We now have individual pages for all of the historical pieces. So you can go back. We've only done a couple years in the archives. We're going to add about another one per month, but you can find hundreds of the top research pieces and podcasts over the past 10 years. You can search for them by topic, by location, idea. It's a really well done service now.
Excellent. Well, again, I want to thank you for your time this afternoon. This has been great. It's been fascinating. MebFaber.com. Check it out. It is one of my absolute favorite and most informative websites available to individual investors today. Meb, thank you so much.
Thanks, bud.
I'll join you in that. Go Dodgers, because my Baltimore Orioles are in the AL East, and the Blue Jays thump them all year long. So,
well, my Colorado Rockies are a single A team at this point, so I can't even cheer for them. They're so bad.
It's really insulting to the good single A teams out there, I got to tell you. Awesome. It should be a good series. So thanks, everybody.
Great. Let's do it again.
All righty.